Hello, Rick Comerick, Certified Financial Planner, and today I have for you the second quarter market review for 2018. First of all, let's pause for a minute. Can you believe that the second quarter is over? That means we have less than half the year left in 2018, or in other words, we've already done over half of the year in 2018. Wow, how does time fly? But enough of my ramblings. Let's go ahead and get to it with the quarterly market review. Here's the market summary. In the U.S., the large stocks did very well, 3.89 for the quarter. If we look across the developed international stocks, they all did the opposite. They did bad for the quarter. However, if we look at global real estate, it produced the best returns for the quarter. Now let's go over to the bond side of the market, and it's kind of the opposite story here. Now for bonds on the U.S. front, they were down. However, on the global international side, the bonds were up. So once again, it goes to show that you need a diversified approach because we never know which asset class will do the best. Let's take a review of some of the headlines that hit the news over this past quarter in 2018. Here's one. Yield on the 10-year U.S. government bond hits 3% for the first time in years. So interest rates have gone up. Unemployment rate falls to an 18-year low. Well, that's some good news. And then finally, inflation hits a 6-year high in May. That may not necessarily be good news, but that's some of the headlines that hit just in this quarter. If we stretch that out to the past 12 months, we can review some of those headlines as well. New home sales growth surges to a 25-year high. That's pretty cool. Trump signed sweeping tax law overhaul into law, and the U.S. imposes new tariffs, ramping up America First trade policy. So once again, these are just a few of the headlines that hit the news over the past 12 months. And as you can see by this short little bar here, really 12 months is really a short-term perspective over this long-term time frame. So the headlines will continue to produce, they will continue to affect the markets, but over the short term, that's really where they have the maximum impact. And really over the long term, there's this high expected return for the financial markets. All right, let's delve into the U.S. stocks. Which U.S. stock was the best for the second quarter? Well, it turns out that small value returned 8.3% for the quarter. I like that, and that's pretty interesting, namely because there is an expected premium for small as well as value. So it's just kind of interesting that both of those lined up on this particular quarter. If you need to learn more about that, feel free to contact me, but that's what we call the size and value premium, and they both demonstrated an effect in this quarter. They don't always do that, but this quarter they of course did. All right, moving on to the country performance. I like to look at this slide in terms of as if it were the Olympics for the financial markets and who would have got the gold, silver, and bronze in the third quarter. Well, it turns out that Israel got the gold, Norway the silver, and Canada the bronze. So those were the top three. Down here on the bottom three was Italy, Singapore, and Austria. So there's a variety of markets to invest in. It's not just the U.S. The U.S. did pretty good for the quarter, but they weren't the best. So again, pointing to the story of having a globally diversified approach. The final slide here on the investments is real estate. How did the real estate investment trust do for 2018 in the second quarter? Well, they did the best. The U.S. real estate returned 9.99, so did very well for the second quarter. Global real estate, internationally speaking, not the U.S., had a slight negative return. So really it was the U.S. that drove the real estate market here in the second quarter of 2018. Oh, I almost forgot fixed income. Second quarter fixed income, the yield on the 10-year Treasury note rose 11 basis points to 2.85. I won't spend a lot of time there, but interest rates, again, they have gone up a little bit. And I will conclude with this statement because I think it's really good and really helpful. And it's a formula for success. E plus R equals O. In other words, you want your outcome to be a good one. And that's going to be a factor of the events plus your response. So let's delve into this. Some people suggest that among the characteristics that separate highly successful people from the rest of us is a focus on influencing outcomes by controlling one's reactions to events rather than the events themselves. This relationship can be described by the formula that I just mentioned, E plus R equals O, event plus response equals outcome. Or if we look at it backwards, this means that the outcome, either positive or negative, is the result of how you respond to an event, not just the event itself. Because of course, we can't really create or influence the events on a day-to-day basis, but what we can control and what we can create is our response to those events, and that ultimately will yield how our outcomes are. All right, with that, I will conclude and say if you have any questions about investment philosophy, the markets, or retirement planning, feel free to give me a call anytime.